Hello, everyone. This is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Tuesday, July 15th, 2025. Apologies up front. We normally do this on Monday. Could not get to it yesterday, so we're going to try to make up for that. We actually have an economic data point that hit this week. That's very important. We'll go over that. But first, let's take a look at the data points from last week. Actually, only two, and one that really matters. Initial jobless claims last week. The expectation consensus was a 235,000 number. It came in at 227,000. So labor market, again, seems to be holding up better than expected or feared for sure. Now, in terms of second quarter GDP, we always show the Atlanta Federal Reserve, their estimate of GDP growth. Remember the first quarter, negative 0.2%. And we expected a rebound this quarter because of the oddity of the first quarter with all the additional imports that came with front-running tariff threats. So first quarter, again, negative 0.2%. Expectation for second quarter, despite the fact all the economic data we see kind of suggest economic weakening, it looks a lot better. It's 2.6%, again, because of some of those distortions. But Atlanta Federal Reserve still thinks second quarter 2.6%. So between the first and second quarter this year, we're estimating U.S. GDP growth of 1.3 to 1.4% annualized, ballpark, which definitely is slower than last year, which came in at about 2.8% GDP growth. So inflation expectations ticked up a little bit last week, but nothing significant, 4 basis points. Up to 2.37%. Again, we like that number, 2.37% average inflation over the next 10 years would be pretty solid, we think. Fed's fund future in terms of Fed rate cuts coming up for the July meeting, almost no expectation of a cut, 93% odds. We won't get it, 7% odds of a 25 basis point cut. Then if we look to the end of the year, the odds of 2 cuts, that decreased last week. It had been 73% odds the week before, came in at 71. And now the probability of getting 2 or more rate cuts by the end of the year, or 3 by the end of the year, the expectation dropped again slightly from 30% down to 28%. So with that backdrop, almost no real economic news last week. What happened in the markets? It meandered. There's really hardly any direction. S&P 500 with U.S. equities, international, fixed income, all I think down a little bit, but nothing significant. So S&P 500 last week down 0.3% on the week. So nothing much to speak of there. Growth got hit a little bit. Not much to say. So on a year-to-date basis, after last week, S&P 500 up a very solid 7.2% for the year. But again, that's overshadowed by international markets, developed market and emerging. So developed markets last week down, also like the S&P, barely 0.2%, but up on a year-to-date basis, 16.8%. Emerging markets also down 0.2% last week, up 14.3% on a year-to-date basis. And fixed income, 2-year yield up 2 basis points, a 10-year up 10, or 2-year up 2, the 10-year up 6 basis points. So again, a little bit of weakness in fixed income markets. U.S. Bloomberg U.S. Aggregate Bond Index down 37 basis points for the week. But on a year-to-date basis, again, a very solid return of 3.2%. So last week, we just mentioned hardly any economic activity or data releases. Not the case for this week. So what really predominates this week are the inflation numbers, CPI, PPI, jobless claims. We'll have retail sales later this week, a couple of housing metrics, and consumer sentiment. So we'll start off with today. Now, these numbers, this has already happened. We've seen the core inflation number, the CPI and the core inflation numbers, pretty much as expected. We'll just the headline number in terms of inflation, CPI metric, came in at a positive 0.3% month over month for the month of June. As expected, year over year, same thing, 2.7%, That was a consensus. In terms of the core, expectation was that it was going to be up 0.3%. It was actually only up 0.2%. So the trailing 12-month number, the expectation was 3.0 was the consensus. Came in slightly better at 2.9%. So tomorrow, though, we do have PPI, core PPI. Those metrics are also expected to be a little bit, well, they're expected to be a little bit better. Core PPI is expected to be up 0.2% month over month. Prior month it was 0.1, but the core PPI year over year is expected to drop to 2.7% versus 3% in the month of May. And that's on the core level. On the headline number, PPI month over month is expected to come in at a positive 0.2% for June. In the month of May, it was 0.1. The year over year, though, that's expected to drop also. Was 2.6%. May, trailing 12 months, expected to drop to 2.5%. Thursday, we'll have initial jobless claims. The last week, again, was better than expected, came in at 227,000 new claims, expected to come in at 234, slightly elevated. Then we have retail sales and retail sales ex-auto. Those are both expected to improve. Month of May was poor in terms of retail sales, both headline number and ex-autos. So for the retail sales, the headline number, it was minus 0.9% for the month of May. It's expected to be positive in June, slightly positive 0.1%. In retail sales ex-auto, that was a negative 0.3% in the month of May. That's expected to be a positive 0.3% for the month of June. Lastly, on Friday, again, two housing metrics, not much to say there. Building permits, pretty much as it was in May, pretty much flat, about 1.4 million. Housing starts expected to be slightly better. It was 1.26 million in the month of May, expected to be 1.3 million for the month of June. And lastly, the Michigan consumer sentiment. This will be of interest. This bottomed down in the low 50s. Seems to be moving its way back up, at least over the last couple of months. The expectation is an improvement for the month of June. June was 60.7, and the expectation for July is 61.4. So that's it for a recap of economic activity last week, markets last week, economic activity expected this week. We thank you very much for your attendance, and we hope to see you next week. Thank you.